The market is always full of noise, whether it's overhype or overdramatic. But principle-driven investing is about finding great companies at great prices. Today, we're putting 4 game-changing stocks to the ultimate test to see which one could be the number 1 stock to buy now. Let's talk about Palantir Technologies. Guys, this company, year to date, is up 375.15% so far. It's $78.78. This company is making serious waves in 2024. If you have been following its trajectory, you know this isn't just hype. Palantir is actually turning heads with real performance, not promises. In the third quarter, Palantir posted 30% year-over-year revenue growth, hitting $726 million for the quarter. U.S. revenue alone surged 44%, with commercial revenue up 54% and government revenue climbing 40%. This kind of growth is phenomenal for a company of any size, but especially one that's scaling into competitive markets. The stock being up 375% in 2024, that's on par with NVIDIA, and it's clear investors see Palantir as a leader in AI. With partnerships like SpaceX and OpenAI, in addition to its position in the $850 billion defense market, Palantir is setting itself up nicely for continued growth, which is what matters, especially with companies with this balance sheet, which is incredible, as well as with this could be lofty valuation. Analysts project 43% earnings growth next year, but the net income isn't the real driver. It's all about the cash flow. The excitement is absolutely real with Palantir, but it's not just about the excitement, because excitement doesn't pay bills. Profit and cash flow does, and that's what this company has. So look at this, guys. This company got as low as $5.83 or something like that back just 2 years ago, 1 year ago, a little over 1 year ago. It's now a $194 billion company, but more importantly, look at this enterprise value. Same or lower. That means there's net cash on hand. Now, of course, PE 406, price of free cash flow 198. 5-year PE doesn't exist because they have a negative net income. But look at this free cash flow, $1 billion in the last 12 months, 380 for the last 5 years. Ignore the 5-year number. This company is coming in its own. Just focus on now and the future, because I don't see this company probably decreasing its revenue and profit anytime soon. This is a phenomenally run business. Now, the CEO, he's a psychopath. There's no ifs, ands, or buts about it. The guy is a nut job. That could be great. That could be bad. Steve Jobs was a nut job. Bill Gates was a nut job. Elon Musk is a nut job. Is Alex Karp the next one of these? He very well could be. I've said this in many videos about Palantir. Alex Karp, just focus on building a great business. You don't need to go attack everybody out there. Focus on building a great business. That's what Steve Jobs did. That's what Bill Gates did. That's what Elon Musk did. Granted, Jobs and Gates grew a ton when the internet wasn't as accessible as it is now, but geez, oh Pete. In fact, the internet didn't even exist back then. So let's check out the 8 pillars. A lot of X's here. Not enough data, tons of shares outstanding increase. That sucks. 5-year, a lot of garbage out here. This one worries me because I think they're still issuing shares from stock-based compensation on Palantir. Well, it's a fast-growing company. They want to bring people in. That's the way to do it. And so there's a little bit of concern there. But again, I want you guys to focus on the fact that their free cash flow is significantly higher than their net income. So value this company right now in free cash flow. Let's see what analysts think. Earnings per share, not that sexy. 36 cents going to 71 cents in 4 years. How? Why is it only doubling in 4 years? Even though it's 15% growth a year, that seems low, especially considering their revenue is doubling, over doubling, and their gross margin is 81.1%. How the hell do you increase your revenue by over 100% with 81% gross margin and you don't quadruple your profit? Well, they're maybe reinvesting in more. I don't know. But this is a company that has a long tailwind, has a very long runway, and a lot of things behind it. So this is incredible. Now, no matter what it is, we got to marry the story with the stock, with the numbers. The story is incredible. The numbers are incredible. But together We put it in Stock Analyzer tool to give us some sort of idea of what a reasonable price to pay for a company is. Because remember, every investment is a present value of all future cash flows. That's one of our foundational principles in principle-driven investing. You've got to make sure that you don't just overpay for a good story. And you've got to make sure that you're not too conservative in the numbers, not taking into account the full story. It's about combining those two. And for Palantir, both of them combined are major runways for the company. Now, these are the assumptions I made on Palantir not too long ago. 10-year analysis, 12, 18, and 24% revenue growth. Guys, these are huge numbers. 18% revenue growth is 5 times greater revenue. So entirely possible. But just keep that in mind. That's 5x in the next 10 years. Profit margin, I did 15, 25, and 35. And free cash flow, I did 20, 30, and 40, which may be low considering they did 37% free cash flow margin in the last year. So I might be low on this one. So let's bump some things up here just to see. Let's go 25, 35. Let's go 25, 32.5, and 40 on both of these. Now, PE, I did 15, 20, and 25. Let's do 18, 22, and 26. And finally, guys, I'm doing a 9% return. Now, 9% return is the market 9 or 10%. This is for intrinsic value. What would I get if I were to invest in what price I have to pay to get basically the stock market return? You need to have a much higher number than this because you need margin of safety. Guys, to be a good investor, you have to be not wrong by much when you're wrong. That's the goal here. Margin of safety, put a higher number than 9% in. The more you understand, the lower the number can be. I hit the analyze button. The stock's currently at 76. I have a low price of 10, high price of 48, middle price of 21. Guys, it's just overvalued. Now, some people might say, Paul, you've been saying that for a long time. Yeah, I said that when I was at 45, almost 3 years ago, and it fell to 583. And I said I was interested under 5. I never got to buy it. I'm fine with that. Because at the end of the day, what I don't buy is fine for me as long as the things I do buy make sense. And that's one of the main drivers of our principle-driven investing. If I don't understand it, I don't buy it. And that's what I did there. Now, guys, that's one of the hardest things to get because people will say, well, I understand business. I understand money. Well, remember, a lot of times people will say they understand something without truly understanding it. What I mean in that situation was I didn't understand how Palantir could grow its revenue and profit to justify a high price, so I chose to stay away from it. Another lack of understanding is I don't understand how I lose money in something, how to make money in something, and how to lose money in something. Or another thing could be mortgage-backed securities. Back in the day with mortgage-backed securities, nobody understood those. They claimed they did. Why? Because they were making money off them. Don't confuse making money off something versus understanding it. If you don't understand how it's making money, you will never understand how it loses money. In this situation, I didn't understand the future potential of business that would justify me paying a premium for it. And for that reason, I was out. Stock number 2. Guys, I don't know if you've heard of this company. It's a very, very rare business. It's called NVIDIA. NVIDIA is the darling of the markets, being up 189% this year. 189% this year for a $3 trillion company. That's incredible. They are the poster child for what happens when a company positions itself at the intersection of technology and necessity. Call it luck, but guys, they knew the future was going to involve chips and they were ready and willing to go when AI hit. AI and data centers are the new gold rush, and NVIDIA's GPUs are the picks and shovels that everyone needs. If you don't understand that reference, back in the gold rush of 1849, the guys who made a ton of money were the ones who sold the picks and shovels to everybody trying to hit it big and very quickly. In 2024, their data center revenue hit $47.5 billion, a 217% increase. Q4 revenue was $22.1 billion, up 265%, and even more shocking, their earnings per share soared 765%. Guys, they're not just staying competitive, they're staying ahead. The Blackwell AI chip launched in March of 2024, and partnerships like Meta deploying 600,000 NVIDIA GPUs solidify their dominance. Guys, They own the space with an amazing 88% market share in GPUs. But remember, with the high margin and people catching up, it's a place where it's going to take a lot of effort to really keep that 88% market. Look at Intel back in 2000. Look at Microsoft with Serve. All these things, people will go after them. Doesn't mean NVIDIA can't do well with that, but don't think that market share is going to last forever. And of course, NVIDIA trades at a premium. Look at it this way. They're currently selling for 61 times free cash flow, 55 times earnings. But guess what? They have a lot of growth potential. But when you're buying NVIDIA, you're buying a piece of the future. The question is, does that future growth justify the current price? That's always the question we have to ask for everything we buy. That's what makes an investor an investor. The person who focuses just on a great story is a speculator, because even though they're not saying it, what they're doing with their actions is saying there is no price too high. Guys, this is an incredible company. 3.46 trillion market cap, $3.48 trillion enterprise value, 56 billion in free cash flow. Let's look at the pillars. Can I guess what it's going to be? Everything's a check except for valuation. But again, these 5-year numbers don't matter. Why? Because their 5-year numbers are insanely higher than they were 5-6 years ago. Focus on the future here. As long as you believe that they're on a permanent plateau of revenue and profit. If you remember back during COVID, when shipping costs skyrocketed, we used to pay $4,200 to get a container from China. Went up to $25,000. All of a sudden, people were paying through the nose for shipping container businesses. And I was like, wait a second, this is temporary. And sure enough, it was temporary. But this one might be different because their GPUs are incredible. The world is shifting towards AI, just like the world was shifting towards the internet 25 years ago. But again, in that 25 years, companies went under. NVIDIA is not going under. It would take fraud for them to go under. So let's see what analyst estimates are saying about NVIDIA. $1.27 to $5.95, almost 5x. Almost 5 times growth in earnings per share over the next 5 years. Revenue growth, $60.6 billion to $278 billion. Over 4.5x revenue growth. Man. Guys, but again, we don't know the future. Will other competitors come along? NVIDIA is the clear leader right now. But just like Tesla came around and then other car companies started making electric vehicles, Tesla is still probably the leader in electric cars, but everyone is making an electric car right now. So let's go to our stock analyzer tool and look at our assumptions for NVIDIA. Okay, 10-year assumptions. I did 10, 20, and 30% revenue growth. Guys, a lot of revenue growth there. 20% a year is huge. Profit margin, 30, 40, 50. Same with free cash flow. Now, look at this. The last year, they did 50% in free cash flow, 55% in profit. I have a hard time believing that's going to be held up, but maybe it will. These are Visa-type numbers, guys. And Visa has like no costs. PE, the 20, 25, and 30, and 9% desired return. These assumptions here are not what I believe. It's what I'm doing for the video to show people that maybe be a little careful on video, because these are all the rosiest of assumptions in my opinion. You hit the analyze button and it's going to give you a valuation. This is what makes this tool so important. So the stock's currently at 139. We have a low price of 43, a high price of 450, a middle price of 147. So guys, if you believe my middle assumptions, you can make about 9.5% return on NVIDIA based on a discounted cash flow model. But again, these are the rosiest of assumptions. What kind of investor makes all their decisions based on the rosiest assumptions? That gets rid of the whole idea of margin of safety. We need that margin of safety. It helps us make better decisions and helps us that when we're wrong, we still do okay. Now, obviously with NVIDIA, this is a very, very exciting hype stock, but also with great fundamentals. That story is absolutely incredible and probably getting better. What's important, like we talk about over and over again in principle-driven investing, it's about merging the story and the numbers. And one of the things I've seen that's been most effective is going into the community and having this conversation, because a lot of people in our community love NVIDIA, love the story, realize the story is getting better. For me personally, whenever a company jumps up so fast and so high, it always gives me a little bit of concern. This isn't my type of investment from a long-term perspective because of the revenue growth, but that doesn't mean it's not the right investment for you. A lot more people will understand NVIDIA better, and that's why the thousands of people in our community are able to have different perspectives. When you take those perspectives and you merge them with the numbers in our stock analyzer tool, you can figure out if it's the smart investment for you. All of the tools that we built in our software were made to help everyone, including myself originally, make better investments for myself. So here's the good news. If you join our community today and you join our software today, you will get all of these tools. And the reason I say all of these tools is we are making changes behind the scenes. It's more about better serving you than it is about serving me. So we have our developers constantly working on making the software better for you so you can continue to make better investing decisions and sleep better at night. And our trial of $7 for 7 days, if you click on the link in the description below or go to everythingmoney.com/signup, will allow you to test out the software. Guys, it's $7 for 7 days. It's a no-brainer. Start the year off right by joining the community and realizing how it can make you a better investor and help you sleep better at night. Stock number 3, guys, Southwest Airlines. Now, this is a stock that I've had for a little bit of time. And again, don't ever buy a stock because somebody on the internet or somebody does that. We're here to teach this process. But Southwest has been hit hard since COVID. But the interesting thing about Southwest is their revenue growth. Their revenue in the last 12 months is record revenue. Even before COVID. Before COVID, their record revenue is $22.4 billion. They're at $27.38 billion. Southwest built a reputation as the gold standard of efficiency in the airline industry. They operate 3,100 global routes using a point-to-point strategy, avoiding the inefficiencies of the hub and spoke model that every other airline does. In addition to that, the entire fleet is the exact same Boeing 737s, which simplify maintenance and training, which allow over 3,200 daily flights. So now, with pilots, with mechanics, with their flight attendants, they're all trained on the same planes. They all know what to do. Financially, Southwest is bouncing back. In Q3 2024, they posted $67 million in profits on $6.9 billion in revenue. Now, that's not a lot. That's 1%. But my entire thesis goes back to what their profit margins were before COVID. They're even now ditching their famous open seating policy to attract higher paying business travelers in a way to generate higher profits. This company, until COVID, had never lost money, which was ultra rare. First off, to even not have a bankruptcy is ultra rare in the airline industry. And global air travel is set to double by 2030. This will help Southwest's lean model and strategic vision make it a company built to soar once they get back to these pre-COVID profit levels. $22 billion, $22 billion, $21 billion in revenue. Profit for those years, 2.3, 2.5, and 3.36 billion in revenue. That's 11 to 15% margins. Compare it to their 1% they just did last in Q3 2024. My entire thesis here is based on them getting back to a more normal level of profitability. And here's what's interesting. From an 8-pillar perspective, it's garbage. Yes, they have revenue growth. Yes, they have profit growth. Everything else is garbage. Fine. Let's check out what analysts think about this. $1.61 to $3.30. Now, I don't know. This still seemed pretty low to me. If they can just get back to 10% profit margin, 10% profit margin on $35 billion is $3.5 billion in profit. $3.5 billion in profit times a multiple of, call it 18 for Southwest Airlines. What does it take that market cap to? Well, 3.5 times 20 is 70 minus 7, which is $62 billion market cap. What's their current market cap? Their current market cap is $20 billion. So it takes them from 62 billion to 62 billion from 20 billion. That's 3x the money. That's my thesis here. My thesis here is based on getting back to that normal profit margin. But here's the great news. Let's say they get to 6 or 7%. Do the math. It's still a much higher market cap than it is today. That's the idea behind Southwest Airlines. And I'll show you guys that in our stock analyzer tool to really drive home this point. I'm doing 2, 4, and 6% revenue growth. Profit margin, 6, 10, and 14. Let's go back down to, let's go to 5, 8, and 11. Which again, 11 being their high number was still what they were doing before COVID. Hit the analyze button. You see what I mean here, guys? 32, 115, and 66. 19% potential return based on discounted cash flows. This one I think has a lot of juice left in the squeeze. Again, could be wrong. The airline industry is a very, very tough industry, but I'm going to bank on Southwest Airlines' ability to operate great like they always have before COVID. Now remember, guys, when we're looking at companies, it's about comparing them. So if you have an exciting company like NVIDIA or Palantir, and you have a company like Southwest, which isn't exciting, you got to remember that the whole reason why Southwest is beaten down is because people are ignoring it. People think the story is bad. That's how you make more money. I'm not telling you you're going to make more money on Southwest than Palantir and NVIDIA. That's not the point. But the point is, if everybody's crowding to one investment, the juice left is probably not as big as the one where people are exiting. That's the kind of ideas we're trying to teach here. It's not about thinking, it's about thinking differently and being right about it. For example, I'm not banking on BlackBerry saying everybody doesn't want BlackBerry because no, I'm sitting there saying, listen, BlackBerry's probably pretty much just going to be government work and all this stuff. Apple dominates. Samsung dominates. Google dominates. BlackBerry's probably not making a comeback. It's not about thinking different and being right, or where that juice is worth that squeeze. At 19% potential returns on what I think were lower margins for Southwest, that makes a lot of sense to me to give it a shot, or at least put some money there for myself. That might not be the case for you, and that's okay. But that's what we're trying to teach here. This principle-driven investing isn't about saying, I'm going to make one bet and be right on it. It's about making several bets and saying, okay, if I have all these bets that generate 20% returns, even if I'm wrong on all of them, I can probably still make good returns. That's the key there. So, stock number 4. Nike, another company I own, and you know the rule on that one. Don't just buy a company because I do, but Nike isn't just a brand. It's literally a cultural movement. Whether it's LeBron or Weekend Warrior, Nike has built a brand that resonates across multiple demographics. Athlete endorsements like Ronaldo and Serena generate massive earned media value, and the LeBron lifetime deal alone has reportedly surpassed over $1 billion. Michael Jordan makes like $350 million a year because of his brilliant negotiation back in 1984 for his deal with Nike, getting 5% of the revenue. But Nike also continues to innovate. Products like the Vaporfly are revolutionizing performance, and their Move to Zero initiative aligns with the sustainability trends that many companies are going towards. They own 25% of the global sportswear market, with 40% plus of that coming from direct-to-consumer channels, which is a high revenue and high margin business. Now, Nike trades at a premium, but guess what? They should. Because when you factor in its global reach, its cultural relevance, and the operational excellence, it absolutely deserves that premium, and you must consider it, especially considering the stock is down from an all-time high of 180 back in November of 2021. And it recently, in August, got down to $70.75. Now, this is a company where I truly believe that as it falls, you've got to consider buying more of it. Yes, I see people commenting saying, they went woke, they're going to go dead, this company is losing it. Maybe. I doubt that. Think about 10, 20 years from now. Do you think Nike will still be around? Unless you're an absolute naysayer, it's hard to see a world in which Nike's not around, especially when they have LeBron and Michael Jordan alone, just on their basketball shoes. Forget about everything else, just those two alone. And guys, on top of that, look at this return on capital. 5 years is 18.66, 1 year is 20.43. And I'm willing to bet that this ROIC is going to continue to increase as time goes on. This company is a moat, and the high ROIC, over double the market average, tells me it's a moat status business. Let's see what analysts are saying, because it's incredible here. 281 in profit, going to 636 per share. 636, what premium you put on Nike, times 20 is $130 a share. Okay, that's 4 years from now. The stock's currently at 75. That's a pretty good number here, guys. And I do think Nike deserves that premium. So let's go look at this 8-pillar and out. Look at this. 8 pillars. Guys, this stock is down. It's down to $75 a share. Still an X on the PE, and I've been buying it sub 80. And I'm going to continue to buy it. I'm hoping it goes to $40 or $50 per share. Is that likely to happen? I have no idea. All I know is if it makes sense to me, which we'll look at shortly in our stock analyzer tool, you've got to be prepared to buy stocks at lower prices if they still make sense. This is what makes investing difficult. It's not the numbers. It's the ability to say, the numbers tell me this, but the market is telling me this. Which one do I believe? Well, it's no coincidence the best investors of all time are making the purchases as people are buying. In order for stock to go down, people must be bailing on it for some reason. Most of the time, it's for the right reasons, but sometimes it's just a mood shift. And I think on Nike, it's been a mood shift because I want to make note. When Nike was this high, people were calling us crazy for saying we'd be looking at Nike well under $100. Nike's not going to go under 100. Now that it's under 100, what are people saying? Well, this is why it's going on. This is why it's under 100. This company's dead. Well, which one is it? Some point, both of them are probably wrong, right? That's the difficulty about being an investor. So let's pull up the stock analyzer tool. Let's pull up Nike very easily in our search. Guys, here are my assumptions on Nike. Revenue growth, 3, 5, and 7% over the next 10 years. Nothing sexy. 10, 11, 12% for profit margin. Same for free cash flow. I did a PE, 20, 23, and 26. Guys, you got to put a premium on Nike. That's completely my opinion. I get that. So I shouldn't say you've got to. But if you're not going to give it to Nike, who are you going to give it to? High returns on capital. Great business. Great world dominance. They've got LeBron. They've got Jordan. And they're just getting bigger and better. And they're getting direct-to-consumer sales, which are increasing their margins. 2023 and 26, 9% desired return. I hit the analyze button. The stock's currently at 75.05. I have a low price of 60, high price of 119, middle price of 85. At today's current price, it's a 10.73% discounted cash flow return for the next 10 years. If you want to find more opportunity like these, check out our video, Best Stock Deals in the Market Right Now. It's packed with actionable insights for value investors. Thank you for your time.